And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning and welcome to the show. It's, of course, Hump Day as we move into the month here, heading up on mid-month already, which also means that on Monday we start to close the window, shutting it, slamming it shut, closing it down, locking it out, stock buybacks. Those will start to close out on Monday as we start. Now, primarily start with the financial sector. They're the first ones to report. And as we move further into the month of June, then we'll start closing more and more of that window for share buybacks. Of course, as we talked about before, that's been when you look at the stock market rally from the April 9th lows, that was exactly when that window reopened for stock buybacks. So we've had a big surge in buybacks over the course of the last month and a half. That's helped facilitate this rally. So again, that's not necessarily good or bad. It just, we're going to start to lose one of the buyers for the markets. And again, it's a fairly sizable buyer. It does help move prices. There's a very high correlation between asset price movements and stock buybacks. So again, not the end of the world, but just something to consider, particularly if, we talked about before, if you were really panicking about that bottom in April, really stressed out in your portfolio about losing money, this is a good time to just think about maybe taking a little profit off the table, rebalancing some risk a little bit. Don't be too greedy, as always the case, just because we are going to move into that reporting period. Now, speaking of earnings reporting period, that starts in July. Earnings revisions are being revised up now. Why? Because of a weaker dollar. That's right. A weaker dollar actually leads to better earnings because of the currency transition that occurs. So we're going to see a bit of a boost here over the next week or two on earnings revisions to the upside going into quarter two. Of course, also tariffs have not been the big event that everybody was expecting. Companies are absorbing a lot of this right now. But again, most of these tariffs are on pause. And again, this is the one thing too that the markets are kind of overlooking is they're going, oh, well, tariffs are no big deal now, but tariffs are just paused here for the next couple of months. Again, we'll see what happens in, when that 90-day window, closes, but we haven't heard a whole lot about, deals getting cut, those type of things. So we don't know what the real risk is to tariffs at this point. And how that may impact the markets, later this summer. And again, that's kind of one of the risks to be paying attention to is that we've had a very strong April and May. June has held up, been a little bit slower month, but, still holding up here well. Markets rallied yesterday. But as we get later into the summer, some of this stuff may start to kind of feed back into the markets. So again, we're kind of having a very nice rally in the markets at the moment, but again, it's not all risk is off the table by any stretch of the imagination. We may see a recurrence of some of this later this summer. Today, of course, is also the inflation report, CPI. Tomorrow is PPI, so we'll get two inflation reports this week. Expectations right now are that we'll see an uptick in inflation this month on a year-over-year basis because we had weak readings about a year ago. So if we get a print of 0.3 today, got the hiccups, my apologies. If we get a print of 0.3 or 0.4 this morning in terms of the inflation print, that's going to probably lift the year-over-year comparison rate from 2.3 to 2.4. Again, not a big deal. We're very close to the Fed's target. But again, nothing remains, flat forever. Now, the expectations are for this print to be a bit higher. Now, there's a couple of things that are going on. First of all, the Bureau of Economic Analysis is having to use a lot of alternative sources for their data collection. So there's going to be a lot of questions today about the validity of the inflation report. Good or bad, indifferent, doesn't matter. If it comes in weaker than expected, everybody's going to say, well, yeah, but there's a lot of collection going on. So if you haven't heard what's going on, just to be clear about this, the Bureau of Economic Analysis is saying they're having to use a lot of alternative sources because they don't have enough people because of the cuts in Washington because of supposedly Doge or whatever, that they cut employees. and they don't have enough people to go collect all the data. So they've had to take cities like Duluth and Buffalo out of the mix, so to speak, and they're not collecting prices on eggs and milk and these type of things in those areas, which then that data is collected, and that's what the Bureau of Economic Analysis uses for their inflation numbers. So there's going to be a lot of whether it's hot or cold today. There's a lot of people, the validity of the number, isn't that great because they're having to use these alternative sources. Look, there are a tremendous number of really good sources of data out there for labor, for inflation, for everything else that could be used to get a better rate of inflation. And more importantly, if you want better estimates on the number, stop using all these adjustments, just use moving averages. So for instance, if you want to know what the real inflation rate is or what the real employment number is, stop using all these in seasonal adjustments. Just use a 12-month average of employment, and you don't need to make these seasonal adjustments for summer, winter, fall, whatever. And you'll actually get a better prediction of where inflation or employment is trending. But again, I'm not the government. I don't have to employ millions of people to pay them to do this when you could use the data that's currently available from Paychex, ADP, et cetera, to get much better numbers. But anyway, that's a different argument for a different day. That number out this morning. So we'll get into that at 7:30. We'll talk about it more tomorrow on the show with Michael Leibowitz as well. Quick update on the markets, market trading update. Here's what you need to know before the bell. Let's talk a little bit about small caps this morning. Small caps have been on a tear here as of late. And again, lots of speculative bets now being put on small cap stocks, etc. That's okay. Again, small caps got really beaten up here in August as well. In April as well. They've had a very nice rally here. A lot of people getting excited about small caps. We're seeing a lot of retail investors pile into small caps. Just be a little bit careful here. We're approaching the 200-day moving average. You are at a very elevated momentum signal as well as relative strength, pretty overbought here. If you're trading this trade, I would be looking to potentially take some profits here sooner than later. There's real risk, of course, economically to small cap stocks because they're the most economically sensitive to the economy. Economic data is slowing down. That is going to impede earnings at some point. And remember, about 40% of small cap stocks are non-profitable, particularly when you look at the Russell 2000 index. You have a lot of companies in the Russell 2000 that are non-profitable. And again, we're just about to approach earnings season. And the Russell 2000, like the S&P 600, is also approaching the 200-day moving average. It is very overbought on multiple levels as well. So again, there's nothing wrong with trading that small cap space, but you're kind of at the wrong cycle. You want to be catching small caps coming out of a recessionary downturn. That's when they tend to perform the best. We're at the kind of the peak of an economic growth cycle that's starting to slow down. Higher interest rates, inflation, those type of things still impeding the economy. We're seeing, for instance, delinquency rates and default rates starting to rise. These companies are the most exposed to that. They can't absorb a lot of delinquencies and defaults like large cap companies can. So again, nothing wrong with this trade. Just be careful. Just remember also that, while the S&P is close to setting all-time highs, small caps are still way, way back there. They've just been a real laggard over time. And again, if you go back, 10 years, just as an example, 10, even 15 years going back to 2008, small caps, mid caps, emerging markets, international markets have vastly underperformed large cap and of course mega cap as well, but also the NASDAQ. So again, there's just, the fact that we have slower economic growth that is going to impair their ability to grow. But again, price-wise, they're having a fantastic rally right now. Nothing wrong with that. Just understand we're getting decently overbought on multiple levels. So just don't forget to take some profits, rebalance some risk. If we do get in some trouble in July or August, they're going to have a pullback just along with the rest of the market as well. They're not immune to slower economic growth. All right, that's what you need to know before the bell this morning. We'll come back, pick up with Danny Ratliff. Got a few things to get into with him this morning. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Declare your financial independence from the mainstream financial media and join us for the next RIA Candid Coffee with Danny Ratliff and Lance Roberts, Saturday, June 28th. Know the enemies of your wealth and fight them on your terms. We'll arm you with the information you need. Register today for the Financial Independence Edition of Candid Coffee, Saturday, June 28th with Ratliff and Roberts at realinvestmentadvice.com. realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. Danny Ratliff joining me as well. Danny, good morning. How are you?
Good morning. Doing great.
So, lots of stuff going on in the markets. What's been your biggest question you've been getting lately?
Biggest question, man. Hold on. Let me pull out my Rolodex here. I've got a list. I think right now there's just, there's concern on where are we going, right? Markets have gotten a little bit elevated once again. We're getting back closer to highs. Do we see a bigger pullback? What are expectations moving forward? And I think you nailed it a bit ago. Inflation, right? I mean, it's going to be kind of one of those situations where if it comes out hot, people are going to say, oh, well, you know what? That's just a one-time deal, right? Or it's transitory potentially. But you're also going to have people on the other side of the coin who are going to say, oh, it's here to stay. If it's weak, kind of like what we've seen, a little bit weaker than expected, then everybody's going to say, well, we haven't seen it yet. And so I think that's the struggle right now.
And that's going to be the real question, right? Because this whole thing, like all the estimates for inflation this morning have ticked up because of tariffs.
Correct.
But interestingly enough, the thing about tariffs is that they don't impact everything equally. And most of the things that are getting tariffed are not things that you purchase every day. In other words, we don't tariff eggs. We don't tariff bread. We don't tariff cheese. We have tariffs on things like cameras. How many people bought a camera last week, right?
Well, I mean, probably not many, considering the iPhone and all these other devices are so good, right?
Right. But there's tariffs on iPhones,
correct?
Right? Well, they've been exempted temporarily, but the point is that you're not buying an iPhone every day, right? Correct. So the expectations are these tariffs are going to have this massive impact to the economy, but these are not things that people buy every day. And there's a lot of things that people will do through substitution. They'll just won't buy. Hey, I was going to buy a new phone, but I'm not going to buy a phone now. I was going to buy a new camera, but it's too expensive. I'll just wait. They'll delay purchases. So we may not see that impact of tariffs show up as much as people expect.
Yeah, I agree. And I think that's exactly right. Even during COVID, a lot of people I knew who wanted to purchase a car, they delayed it, right? You're going to continue to see those types of behaviors moving forward, especially if, the thing that you probably want more than need, well, then you'll just push it back. Now, the question with that is that if everybody pulls back and kind of plays that wait and see approach, does that actually put us into a recession?
Yep.
I mean, and granted, it may not be a tremendous or huge one, but granted, it can still be enough to offset things for a bit or just slow things down. And the problem with that will be is that likely we'll find out later down the road that, oh, you know what, we were in a bit of a recession. But, that seems to be the concern. Obviously fixed income right now. Where does that go? We saw the long-term yield come down yesterday. Short end went up a tad bit.
Yep.
That's kind of not what we've been expecting, or what the market has at least.
Well, yeah, but again, as we've talked about before, is what the market expects and what happens in real life are always two different things. And interest rates are a function of economic growth and inflation. So GDP is at 2.3 and inflation's running at 2.3ish. So and yields should be around 4.6, 4.5, 4.6, about where they are right now. That will slow over time. Inflation comes down, economic growth slows, yields will come down as well. If the Fed starts cutting rates, that'll happen a lot faster. But again, there's really, and what's interesting is that the markets are doing just fine, regardless of where yields are right now. Yields aren't spiking. Everybody's starting to become accustomed to yields where they are. Interest rates, for borrowing costs, et cetera. People are like, well, I guess this is where they are. And people are starting to figure out that, well, okay, I can survive in a interest rate environment that's normal. And this is the thing that, we haven't talked a lot about is that, people got used to this idea that zero interest rates was normal. And we talked a little bit about this yesterday with John Penn, but, getting a house for, 2.5% mortgage, that's not normal. Right?
It's great for you.
It's great for you, but it's not normal, and it's not tied to economic development. But, for 15 years, we had zero interest rates. We had, all this support from QE, et cetera. So now interest rates have just gone back to where they should be, and everybody's acting like we're in this massive interest rate, upcycle. And it's just interest rates have normalized to where we should have never been at 0% interest rates, or basically a 0.5% interest rate on the 10-year Treasury during COVID. That should have never happened.
Well, and it should have never stayed there for as long as it did. Either.
Exactly.
That's the other kicker. And, there's so many moving parts associated with this. I mean, now the economy has to stand on its own 2 feet. You've got a lot of the stimulus has finally made its way out of the system. And so that's the other caveat. But the debt aspect of this is there's still so much debt out there. And you've talked about this ad nauseum in the sense of the government needs lower interest rates to refinance. If you really want to be earnest about cutting the debt, that's an easy way to do it.
Right.
To start chopping off and, reissuing these bonds that are maturing. What is it, like $9 trillion still maturing through the end of this year? Mm-hmm. Janet Yellen reissuing those bonds at 2-year notes. I mean, that's a big deal. So you would think they want to do all they can to get interest rates down. I was listening to a podcast yesterday from a large investment bank. They think there's 0 rate cuts this year, but 7 next year. Mm-hmm. But we're not technically in a recession, but we see 1% growth.
Right.
Which could be the case for a bit.
Well, maybe. And again, this is the problem with predictions is that, again, it's like Goldman Sachs just this morning just ratcheted up their GDP expectations for quarter 2 to 3.5%.
Yep.
So, all of a sudden we had this negative print in the first quarter. And that was because of all this front running for tariffs. And we had talked about that is that, by importing all those aspects, you created this trade imbalance, which fed into the GDP report. Well, now that's reversed. And so now you're getting, nobody's importing anything anymore. They've already done it. So now we're going to get this massive boost to GDP growth because of the revision or the reversal of that trade imbalance. So you're getting all these kind of wacky numbers that you've got to separate out and go, okay, let's go back and look at what the trend of the data is. And that trend is showing slowness in the economy. The employment report that we saw, that 139,000, there were almost 200,000 jobs revised lower in previous reports. Nobody cares about previous revisions, but the trend of the data in employment is slowing pretty dramatically. Yeah. And, even 139,000 is below the 200,000 mark that we should be running in the economy. We should be putting about 200,000 jobs on the books every month just to support population growth. And we're at 139. That number is going to get revised down, probably closer to 100 in the next report. So the trend of employment slowing, that certainly suggests the economy is slowing down. That's eventually going to feed back into inflation and interest rates.
I think that's the key, is that how much does things slow down? Where does this go, right? I mean, and that's the struggle with trying to manage money in this environment right now, especially when it's more headline to headline versus actual data, and understanding that data is probably subject to be revised.
Yeah. Well, no, again, Nobody cares about revisions.
Yeah.
So let's just
Well,
start
because
there.
it'll be 6 months down the road, and we'll be
Right.
looking at something different.
Right, of course. But nobody cares about revisions. But, the trend of the data is important, and that's the thing to watch. Now, will we get into a recession? That's tough. That's a tough call. We may get to real slow economic growth in 2026, but we should start seeing an acceleration of growth in 2027, 2028 as a lot of these infrastructure projects start to really kind of kick off and start build outs on these AI data centers and power centers and all this other type of thing. So we may see a year where we have a lot slower economic growth next year. Market's a little bit sluggish, and then things will start to improve after that.
So we have a client who works in the electric field, right?
Mm-hmm.
And they're building out data centers. He's like, if they can do just a third
Of what they say.
of what they say, it's going to be phenomenal. He's like, this is a space that is just, he's like, there's nothing, the infrastructure is not even there yet.
Right.
And, it's going to be a lot of work.
Right. And it's a tremendous amount of work. And this is an article I've got coming out on Friday. Lots of concern about the deficit. And when you start looking at the impact of how much money is going to be spent on infrastructure, it solves a lot of your deficit problem.
Well, we've talked about how that's much more productive use of funds
Mm-hmm.
versus many of the other ways that the government spends money.
Right.
But, we were talking about all the things that, so I'm just thinking in my head of yesterday, Bitcoin, death of the dollar, interest rates.
Yep.
Let's see, gold.
Yep.
She's still getting gold, oil.
Trade.
Yeah.
Tariffs.
Trade, tariffs, the impact of it all. So we could spend all day. I mean, we want to just check them off one by one?
No, exactly. But no, it's just, it's interesting. But, narratives are always, we talk a lot on the show about narratives. And, this is always something. And in 6 months, it'll be a different narrative. It'll be something else, right? Markets are doing okay right now. Things are okay. We're not overbought here sentiment-wise. This weekend's newsletter is really kind of looking at, how much further, this rally can run, because I'm getting a lot of questions right now. It's like, oh my gosh, when's this market ever going to pull back? I want to buy some more, but I can't buy it here. It's just too expensive. Well, actually, you can buy it here, but it is getting a little bit overbought short term. So the market is going to pause here a bit. The easy picking back in early April, that's over, right? The easy harvest for buying stocks, that part's behind us. It gets a little more challenging from here, but there's nothing that we're not, sentiment wise, positioning wise, we're not extremely exuberant. We're about in the middle. And as we talked about in our previous article, the herd tends to be right in the middle. We wrote an article on Monday talking about the right way to buy dips. And the reality is that when you're in the middle of the move from extremes, right, the herd is right. And right now the herd is right. The herd is buying stocks. They're investing in the markets. Markets are rising. So the herd at this moment, that stampede of people, right? If you think about a herd, that stampede is in the right position. At extremes, either at highs or lows, that's where they're wrong. And so this market's got some room to run here as we get into the month of July. But again, I think, kind of my best guess is if you're looking for a pullback, that's not going to really probably occur until maybe August, September. We got a little bit longer to go.
A little bit more
time-wise.
significant pullback.
Yeah, well, I'm just talking about 3 to 5%, right?
Yeah.
Just you get a little bit of a pullback, just something to reset the table a little bit. That's probably not going to be till August, September. It could come sooner. I mean, if we get a really bad slate of earnings reports, I don't see that in July, but it could.
That's stuff we've been talking about, right? But even with what we're seeing, as data changes, information comes, you have to change your view a bit too.
Yeah, absolutely. All right. Quick break. We'll come back. I'm sure Danny's got something else, nauseating to talk about. So we'll cover that as well. Don't go away.
Oh, I can't wait.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Declare your financial independence from the mainstream financial media and join us for the next RIA Candid Coffee with Danny Ratliff and Lance Roberts, Saturday, June 28th. Know the enemies of your wealth and fight them on your terms. We'll arm you with the information you need. Register today for the Financial Independence Edition of Candid Coffee, Saturday, June 28th with Ratliff and Roberts at realinvestmentadvice.com. realinvestmentadvice.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors, online resources, and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
In the chat, they've been going on about first PCs.
Yeah.
And if you had a PC with a floppy drive.
The Real Investment Show podcast.
My first actual quote computer was a Tandy 1000 with dual 5.25-inch floppy drive and a whopping 512K of memory.
Same show, your schedule.
I felt so fortunate in college in my dorm room to have my own computer,
right,
with my own printer.
You were a spoiled rich kid.
Well, I don't know about that.
At realinvestmentadvice.com.
Instead of being in the bar going, hey, what's your major? He's like, hey, I have a computer with a printer.
Why don't you come check out my dot matrix? That's right.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell report. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Thanks for reminding me. Forgot all about that. Welcome back to the show this morning. So here's the question this morning for all you lovely people in chat. Are y'all ready? Okay, so if you're driving in the car, you can just, verbalize your answer this morning. And if you're in chat, I would love to hear your view. You've just been notified by an attorney that you are about to receive a $5 million inheritance. And you have a choice. You can either take it or disclaim it. How many of you are going to disclaim a $5 million inheritance? I'm just waiting for chat to light up here. Danny says, well, if you don't need the money, I need the money. Brent, you need $5 million?
Oh, good.
Brent says he'll split it. And, I don't mind paying the taxes. No. Send me $5 million. You can take $3 million of it. You know what? Exactly. Government can have 50% of it. Cool. I'm all good with that. All right, Danny, why should I disclaim an inheritance? Because I think you're going to lose this argument. Yeah, and everybody in the chat says nope.
This is not an argument. I'm not advocating for this, but there
Yes, you are.
are times when you could utilize it.
You're saying you should disclaim it.
Geez. This is why I can't do things with you, Lance.
Danny, if you get a $5 million inheritance, can I have it?
Absolutely not.
Okay.
No.
Yeah, no. I mean, if you're going to disclaim it, I mean, just give it to me.
Man, do I have some long lost relatives I don't know about? Wait a second. No, but there are strategies.
Okay, in all seriousness, there is an article out. This was in what was it? Think Advisor.
Yep.
Think Advisor, talking about the title of the article is "It's not always a bad idea to reject an inheritance." So,
well, you don't have to disclaim it all. So, number one, you don't have to disclaim the whole inheritance, but you may disclaim portions of it or parts of it. And there can be very good reasons to do so, depending on tax ramifications on the asset. Now, if it's a taxable asset, you're going to get that step up in cost basis. So that's typically not a big deal. But where you generally see this happen more commonly, especially now with Secure Act 2.0, which has changed how many people have to take RMDs, right? If it's a non-spousal beneficiary, you have a 10-year window, you must take all the funds out. If they're already taking RMDs, you must continue to take RMDs throughout that 10-year window and liquidate that account down to zero. So if you are, by chance, in the 35% tax bracket, in a state that potentially has state income tax, and you may be creeping up there into the 50% range. So you start thinking about the use of funds. And you may be able to advocate if you're in a situation like that and you've done very well, it could trigger a couple things, right? Number one, it may trigger the estate tax. So if you get over that amount, $14 million, and if you're married, filing jointly, you get double that. There's other ways you can do. I'm not going to get too far into the weeds of this, that you can condense that number down. But anything above that amount is subject to a 40% estate tax. So let's just call it $1 million above. There's $400,000 that your heirs would pay to Uncle Sam. That could be one reason. Now, one of the bigger reasons would be likely is that if you're in a high income tax bracket, and you don't technically need the funds. Yes, Lance, we know everybody needs the funds, and it would be a significant blessing. I mean, it is, right? And you want to see that these funds are used properly. But also sometimes it could be talking about the generational aspect of this and how do you keep money in the family, but also you want to keep more money in the family's pocket and out of Uncle Sam's. Mm-hmm. So you could, in effect, disclaim it. If it's written in the estate plan that it goes to a trust, it would then therefore go there. If not, then it typically goes to the next beneficiary in line, which many times is the heirs of whoever would disclaim it.
That would be me, because I'm in Danny's will.
Yeah.
As the contingent beneficiary for his disclaimed inheritance.
Go put one last sack of coal on his gravesite. That's what it's going to say.
Exactly.
No, but so you could potentially disclaim it. And you don't have to disclaim all of it, but you could disclaim a portion. And you could say, look, I want this to go to my kids because they're in a much lower tax bracket. It's better use of funds. And one thing we've done a lot over the last couple of years is talking about utilization of funds. And so I have several clients that have said, you know what? I don't want my kids to, number one, I've worked very hard. I don't want to discredit the work that they're doing, right? I want to make sure that their life's work is meaningful. But also, how much are they really going to need this at 60 or 70 when I'm gone? Versus now, while they're building a life, starting families, are there things that I can do to help them out?
Yeah, I don't do that
currently. Yeah, I think you know what?
You know me.
I know you, but I think you're a little softer than what you say.
Nah.
Really?
Yeah. Nah. My kid called me. My son called me on Friday, and he's like, "Dad," says, "money's kind of tight." Says, "So I'm gonna go eat some ice and study for my test." And I'm like, "Well, you can put salt on ice."
Oh, he is your son.
And he was begging for money, but yeah, no.
In a roundabout way?
Oh, yeah, obviously. He was hoping I'd give him some pity and send Venmo him some cash to go buy lunch with. Yeah, no. He's got a job. Go work a few hours and you get free food at the sushi restaurant where you work. Go to work.
I'm with you, but
yeah, no.
I got a feeling that you're a little softer than what you're letting on.
Nah.
No?
No.
Okay.
My kids hate me.
Well, they're going to be better off for it. I mean, I
Of
had
course.
some strict stipulations in college, grades, work,
Yeah.
and don't be an idiot.
Well, you got 2 of them right.
Well,
The first 2.
That's true. Oh, but I'm here with you, Lance. What does that say to you?
Exactly. You got the first 2 right, didn't you?
Oh, man.
Anyway,
So-
but can we talk about something real quick?
Yeah.
Because I think this is more relevant to most of the people watching our show, is inheriting stock.
Yeah.
One of the things that I see individuals do wrong, and again, a lot of people don't agree with this right up front, but hear me out on this, is you inherit, let's say that a relative passes away and you inherit, a portfolio full of ExxonMobil stock that they've owned since 1930 when the stock was originally Mobil, right? And so you've got this very low cost basis in it. And, this was my grandpa's stock. He owned it his whole life. And, I don't want to sell it because this was grandpa's stock, whatever it was. I mean, there's all these emotional attachments to stock. I've seen this happen so many times that people get emotionally attached to a stock position because it belonged to a parent or a grandfather, whoever it was that left it to them.
Yep.
And they don't want to sell it. The parent didn't give you the stock. They gave you the value of the stock for your well-being. They don't care if you sell the stock. They just want you to have the value of it. And there's a couple of things that happen, at the time of death, and Danny can talk some more about the step up in cost basis. But it's important to separate out the emotional attachment to the person that gave you the stock versus the reason they gave you the value of this. They weren't, attached to ExxonMobil because they worked for ExxonMobil for 30 years. It was in their 401k plan, whatever it was. We see this a lot in Texas, by the way, just because we have a lot of clients and people that have worked for major oil and gas companies. So I'm using this as an example because I've seen it in real life. The parent worked for ExxonMobil for 30 years. He got stock for 30 years. He had a couple of $1 million when he passed away. He passed it to the kids. It went to the kids in stock, and they won't sell the stock. Now, fortunately, everything's worked out okay at this point. But I've also seen it with Fifth Third Bank. I had a client back in 2008 that had a $5 million inheritance of Fifth Third Bank. The stock went from 130 to 2 in 2008. And they didn't sell it. And I was encouraging them to sell. It's like, don't worry about the cost basis, because your cost basis, now this is where I need your help, Danny. On death, the cost basis, say their cost basis was $2. When you inherit it, it's $100. Your cost basis steps up at the time of death when you inherit it. Right, Danny?
It does. And so I think that's the important part, is that now I do see often where that cost basis is actually, they've never stepped it up. And so you do need to be cautious. Make sure you work with your advisor, your CPA, and ensure that they actually go
do that filing.
Mm-hmm. Yeah, and it's really relatively easy. A lot of times upon the death, they will actually go ahead and do that. But there's many times that we've had an account come over that they'd already inherited the funds, and you notice like, whoa, wait a second. Mm-hmm. When did your father pass away? And they, it was 2022, this date. And you're like, okay, this is way wrong. Let me go look this up. And then we can go back in and change it. But if you ever got audited by the IRS, you'd want to make sure that those numbers are right. So you need to do your homework. But, it's something that's often overlooked, and we see it over and over. And the problem is, like you mentioned with the Fifth Third Bank situation, you get somebody with a concentrated risk, because a lot of times it does make up a significant portion of their portfolio. And that is, I think, where we have to separate the emotional ties. And you said it perfect. They didn't gift you necessarily the stock, they gifted you the value. And granted, while we know that there's some loyalty there associated with that, there may be times as the economy changes, the markets change, companies change, you may need to change as well. These companies don't have loyalty to you. So we need to think about what is the best way to do so to maybe remove some of that additional risk. And so we actually have some tools and we do some planning that will actually say, hey, here's how much you should take off the table, assuming all things stay equal, right? Unless we get really bad news. Little by little over several year time frame, That way you're not getting just really hit with high income taxes.
Again,
those capital gains.
When you die and go to heaven and you see your grandparent there, and the grandparent's going to say, "Why'd you let that stock go from 130 to 2?"
Now, let me ask you,
what were you thinking?
If that happened, would you consider yourself a good steward of capital?
Exactly.
What would they say? That's a great way to look at it.
That's exactly the way to look at it. All right, come back from the break. Get ready to wrap up the show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Declare your financial independence from the mainstream financial media and join us for the next RIA Candid Coffee with Danny Ratliff and Lance Roberts, Saturday, June 28th. Know the enemies of your wealth and fight them on your terms. We'll arm you with the information you need. Register today for the Financial Independence Edition of Candid Coffee, Saturday, June 28th with Ratliff and Roberts at realinvestmentadvice.com. realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So I was on the show here, gosh, Brent, had to be 5-6 years ago when Beyond Meat first made its IPO. Remember that?
Oh, you would not stop talking about that.
Yeah. I was like, this is the most stupid thing ever.
Yep.
And at the time, everybody was like, oh, everybody's going to start eating, this, Beyond Meat, this, Beyond Burgers, all this is going to be a great thing. The one good thing about Beyond Meat is that during the pandemic, you couldn't get meat in the store, but that shelf was always full. So
let me ask you, how many times did you buy some?
No, I've never bought any. Have you ever read the list of ingredients?
I've heard about it, no, but I've not spent time to actually physically read.
There is nothing healthy about a Beyond Meat burger. So,
Lance, I've got 3 kids. There's not much I'm reading at the grocery store, okay? I'm like, you over here, quit putting crap in the basket.
Exactly. That's the way it works.
We're moving.
Walking. CEO Peter McGinnis says the company's biggest growth opportunity is with consumers who eat some meat. It's now a new transition.
Oh, goodness.
It's now a new transition. So this is Impossible Foods. This is the other competitor to Beyond Meat. So Impossible Foods sets its sight on flexitarians. So, yes. Even Brent's going, okay, this is too much. So I qualify as a flexitarian because once in a while I have a salad. Like,
is that what it's considered now? They made up a word for this?
Yes.
If you eat things besides just meat?
Just if you eat things other than just meat. So, like, look, I will tell you, that I do enjoy a good veggie burger, right? So when I'm in a cut cycle or whatever I'm doing, there's a restaurant in Houston called Beck's Prime. Danny, you know this restaurant, right? And it's not everywhere, but they have probably one of the best veggie burgers out there, right? It's made out of black beans and some other stuff. So I qualify as a flexitarian because there are times that I will have a vegetarian meal, particularly if I'm on a hard cut cycle.
It's just a bunch of soy. What are you doing?
No, it's got to be healthy, right? So,
well, those are perfect names because Beyond Meat, yes, it's not meat, and Impossible. I mean,
Impossible Foods.
Yeah, it is.
It's impossible to eat.
No, I mean.
Good
well,
one,
I tell you what, Michelle tried to be a vegetarian for like a week. And my grandmother.
Michelle is like the size of a straw.
Oh, and she loves a hamburger and she loves steak, right? I mean, our freezers are full of red meat, but she works out. I mean, she takes care of herself.
She's very thin.
And so, my grandmother decided if we went over for dinner one night, the whole family, and everybody's eating well, and she gave her noodles with butter and Parmesan cheese on it because she didn't know what to give her. And so she's like, never mind. I'm not doing this. I was like, thank God. Thank you, Nana. You're a savior. It's like, we're about to end it right there.
So anyway, so this is now, apparently this is now Impossible Foods' next target, which is trying to come out with so Impossible Foods, this is from the article in the Wall Street Journal. Impossible Foods faces an unsavory conundrum. How can a major marketer of plant-based meat succeed in a shrinking industry? More people are turning away. It had its brief moment in history, and now people are turning the other direction, going back to, I want real food. It's taking steps to tackle the challenge, including a new brand identity that stresses the meatiness of the company's products and a plan to woo flexitarians. The company is switching package colors from green to blood red.
Wait a second.
And they've hired a hot dog eating champion as a brand ambassador and expanded product offerings once focused on ground beef substitutes to steak bites, hot dogs, and chicken tenders. So,
who is this hot dog eating champion?
It does not say.
It's Joey Chestnut. What a sellout.
What a sellout. So it is interesting. So, I mean, they're trying to figure out a way to survive in the market. And,
yeah, I mean, you got to be flexible and make changes. I think it's, I don't know. I just love they're coming up with new words. I just, at the end of the day.
Can you imagine sitting around the boardroom at Impossible going, okay, what do we call people that eat a salad every now and then? I have an idea. Occasionalitarians. No, that doesn't work. It's too long. How about flexitarians? Scott, that's it. We're going with it. Flexitarian.
And that guy got a raise. Isn't that
he
crazy?
did. He got a raise for it.
That's genius.
Something in the article struck me. They said plant-based meat.
Yeah.
Well, when you think about it, all meat is plant-based.
That is correct. It's just how you get there, right?
Mm-hmm.
So somebody at Impossible will start selling actual meat, and they go, well, it was made from vegetables originally.
There you go.
Well, if it doesn't work, keep on trying.
So anyway.
Well, so we were talking, Lance, about, inheriting when you inherit stock and some of the things you need to be considering. But one thing actually came into, had a conversation with somebody yesterday, is land, right? Mm-hmm. And so how many times do you know somebody who owns land, that same situation, says, do not sell it, but it's probably not an income producing asset, or if it is, it's very little, right? You may be breaking even. But when we talk about, earlier we were talking about disclaiming inheritances and some of the issues that you could face from an estate tax problem. We see this with land specifically, is that if somebody's going to inherit it, and that land may have a ton of value, especially, if you look at Texas farmland over the last, 10, 15 years, it's gone through the roof.
Yeah.
And so you have some people who on paper look extremely wealthy, but the liquidity aspect of it is very small, right? It may be a ranch or a farm that's been in the family for years, closely held businesses. We see this with family-owned businesses as well. But when they get down to it, they have this big tax bill when somebody passes, and you have to liquidate it anyways because you don't have the liquidity, you don't have the cash to pay an estate tax. So we're seeing more and more people encounter those types of issues as well.
Yeah. Well, and I was actually just, as I was telling you on the break, I just was recently talking to, somebody in that same situation, is that they're spending money every year
Yep.
just to maintain a property. that they were told never to sell. Dad says never sell this property, and they're spending a lot of their own cash every year just to pay taxes and do upkeep and maintenance and that stuff on the property. But there's no plan to ever go move to this piece of property and live on it or convert it to a farm or whatever. I'm like, why would you just not sell it? Well, Dad told me not to. I was like, that's stupid.
Yeah.
Right.
Well, but at the end of the day, what does that do? What's the impact to your financial plan? Do your kids really have an interest in that property?
Yeah, the answer is no. By the way, I see this a lot too. Is parents go, well, when we die, we're going to leave our house to the kids. The kids do not want your house.
I tell everybody, listen, if it's not on a lake, a mountain, the beach, a pristine river, they don't want it.
Yeah.
Don't even entertain it.
Yeah, just liquidate the house in your estate plan and give them the cash.
And do them a favor. Start going through your stuff now.
Clean out the garage, please.
Yeah, I'm going to have to start having like work days with my dad on weekends. Like, hey, man.
Is your dad a hoarder?
He's a collector is what he calls himself.
He's a flex hoarder.
Yeah. Yeah. He's gotten much better, but so my mom died when I was young, and he got into collecting antique bicycles.
Okay.
And like motorcycles. I think at one point he had like 13 storage units. It was nuts.
Bicycles.
Oh, they were in movies. He was one of the largest in the country.
And what was the purpose? I mean, did he sell them?
Oh, yeah. Yeah. I mean, he sold most of them, almost all of them at this point. But that, like Lionel trains, I mean, just all the old stuff, right? He's turned into a big kid. And so something he liked, and he just got into it a little bit, and it took off. And so he still has some things, and I'm like, Dad,
but at least he's turning this into a little bit of a profit-making motive.
Well,
right?
it was. I mean, this is 20 years ago. He doesn't do that stuff anymore.
Gotcha.
But he does still have, some here, some there, and it's like, oh, geez.
Yeah, I have to go through it.
Yeah, that's right.
So,
fun stuff.
All right, coming up here in about 30 minutes is going to be the inflation report. That's going to be the big market mover for the day. Again, markets rallied pretty decently yesterday on expectation that this number's going to come in line kind of with expectations. There's not a lot of expectation that, again, this is going to be an overly hot print for any reason. Markets are kind of anticipating that a bit. So we'll see. Even yields sold off yesterday, which, if they were worried about a really hot inflation print, I imagine we'd be getting some selling before the number. But again, we don't know how this number is going to come out this morning, but it will move the market to some degree, particularly the bond market. And then tomorrow morning, we'll talk about it in more detail about what the actual number is. But then tomorrow we get the producer price index, and then that will be kind of the final two that we'll get before we get the PCE report on Q1. So again, there's a few things coming up, and of course we got the Fed meeting right around the corner as well. So all eyes are really going to be on this report in particular. And what that potentially means to the Fed rate cut coming up. Expectations are right now the Fed's only going to cut a little bit more than 1.5 times this year. So it's either one or two because, you can only cut by a quarter basis point. So they'll either cut once or twice this year. But that's, the expectations for, we came into this year expecting 6 rate cuts. We're now down to roughly 2. And depending on this print, that could go down to 1 or maybe even less than 1. And again, like Danny was saying earlier, it's more expected that we're going to see a larger series of rate cuts next year as the economy continues to slow, and the Fed's going to want to start bringing down that interest rate on the short end of the curve to get it more aligned with where economic growth and inflation's running. In other words, right now we're at 4.3% on the Fed funds rate, and you got inflation running at about 2%. So they've got about 2 percentage points that they need to pull out of that Fed funds rate to get it down to where inflation is. So that wraps up the show for the day. Danny, thank you so much.
Thank you.
All right, Danny's going to go work on being a Flexitarian today. He's going to have a salad for lunch.
Woohoo.
And we'll be back tomorrow with Michael Lewitz to talk about the inflation number today and what happened in the market. So we'll see you all in the morning. Have a great day.